In this lecture, we're going to introduce the new standard IAS 21. Right, so in terms of where we are to date, the last main area we covered was disposal of subsidiaries, and we said there's four main scenarios, depending on whether you sell all of the subsidiary, partially sell the subsidiary, or whether you maintain control. So it's important to go back over those. That's one of the three main complications you can have in consolidation questions: disposal of a sub, a foreign operation or foreign sub, or a consolidated statement of cash flows. And we're going through all those three towards the latter end of semester 2. So in terms of IAS 21, that covers two main foreign exchange issues. Right? The first main issue, what we're going to focus on this particular recording, is the translation of foreign exchange transactions. So this is applicable to any company. It's not necessarily related to consolidation at all. So if you have a company that is selling to the UK, so selling in sterling, or it's buying goods from the US in dollars, or it's get a loan in dollars, or it deposited money in sterling, or anything like that, we need rules around, well, what exchange rate do we translate at? How do we account for any foreign exchange gain or losses? So individual transactions that any company engages in, doesn't matter whether it's a group or an individual company, that's covered in the first part of IAS 21. The second part of IAS 21 focuses on what happens if we have a foreign subsidiary and we need to translate financial statements into the group, i.e. the group currency, which would be the presentation currency. So we need to have rules around, well, how do I calculate goodwill? What do I do with foreign exchange gain or losses on acquisition and post-acquisition? So that's much more complicated, and that's probably the hardest area of group accounting, and we'll have a separate recording on that as well. So for this part, we're looking at the first element of IAS 21, how an individual company engages in transactions. That could be purchases, it could be sales, it could be depositing money in a foreign currency, or borrowing money in a foreign currency. And that's not related to consolidation, but it's just covered because all of IAS 21 comes together as a package. And then in the next section, we'll look at where an entity has an interest in a foreign operation. In particular, what we're interested in is a foreign subsidiary. So we'll focus on a couple of the key definitions first to get going. The first one is a foreign currency. That's a currency other than the functional currency. So again, you're kind of looking at chicken and egg in terms of what a functional currency is. But if you just remember, the functional currency is the kind of base currency. We'll talk about a definition of that in a second. Any currency other than that will be a foreign currency. So in most of the companies in Ireland, their functional currency is euro, because that's what they do their main operations in. Any transactions other than that in a different currency, that will be known as a foreign currency. And a foreign operation can be a sub, associate, joint arrangement, or anything that's based in a currency other than that of the reporting entity. So for our perspective in AC571, we're interested particularly in a foreign sub. So that could be a US based sub in dollars. It could be a UK based sub in pound sterling. But two of the main definitions that you need to understand are presentation currency and functional currency. And we'll look at those in the next slide. So your functional currency is the currency in which the primary economic environment in which a company operates. Now, for a lot of basic companies, domestic SMEs, small and medium-sized enterprises, that's going to be very straightforward. It might have a couple of export sales, might have a couple of import purchases, but the majority will be based in euro, based in Ireland. You get a bit more complicated then, for example, a multinational. So Google, a Facebook, or something like that, where you're trying to figure out where's our functional currency. Because you need to determine that to figure out how do I account for every other currency. So your functional currency is like your base currency. That's what all our transactions are going to be in. And any transaction in a different currency will be deemed a foreign currency. And that means you're going to have to apply IAS 21 rules. Presentation currency then can be any currency. That's with the currency in which the financial statements are presented. So you could have a euro-based currency with functional, and they may want to present in dollars. Or they may want to present in sterling because they might be listed on the UK stock exchange. But generally, a company's functional currency will also be its presentation currency to avoid a lot of extra work in terms of translating those. So functional is where the main transactions are of the business. Where does it borrow its money? Where does it make its sales? Where does it make its purchases? And we'll look at some of those factors in a second. Presentation currency then is what are the actual denomination of the financial statements. And usually they're one and the same, but not always. There can be some exceptions. So determining the functional currency, you look at primary, secondary, and additional factors. right? So your primary ones, the obvious ones, are where your sales are denominated, right? Where your main competitors are, and where your main expenses are. And they'll be all the very obvious ones you're looking for, is where you're getting your sales from, where you're getting your purchases from, and where's your main competitive environment. That may be clear cut for some businesses, for multinationals and whatnot, maybe a bit more complicated. But generally you're not going to be asked that in AC571. You're going to be given the situation of where the subsidiary or where the transaction is based. But you do need to know the narrative, the logic behind the standard, because this can be quite an important decision when you go to more complex transnational cross-border businesses. Some other secondary factors then would be where the funding is from. So where is it getting its financing activities, or where the currency is usually kept? So where do you actually retain? Where is the money on deposit? If it's uncertain with the primary factors, then you might go to secondary factors. So a small little example might help to kind of consolidate what do we mean by that. So take a company like Cramwell, which sells most of its goods in the Eurozone. So therefore its sales invoices are denominated in euro. 60% of its company's costs are in euro. However, the remaining are from production plants in the UK. So all its sales are in euro, 60% of its costs. So that from the primary factors here, it's quite straightforward. This functional currency here is euro. Yes, 40% are in sterling, but that would mean in IAS 21 that all the foreign currency transactions, in this case all the sterling transactions, 40% of the whole cost base, will have to be translated into euro using IAS 21. So for globalized businesses, multinationals, IAS 21 is quite an important standard, because there's very few companies now at a particular scale that are just going to be doing euro-based transactions, or just going to be doing sterling. There's going to be importing, there's going to be exporting, there's going to be cross-border financing. So it has quite a practical importance when you get to the real world. So then we have an idea in terms of the definitions then around functional currencies, presentation currencies, and foreign currencies. Of course, what we need now is a solid set of rules. Now remember, we're only looking at individual transactions here. We're not worried about translating a set of financial statements. That'll be for the next piece of IAS 21. For now, we're just worried about if we make a foreign sale or if we make a foreign purchase, how do we translate that into euros? Because the companies we're going to be looking at are going to be euro-based companies. So in IAS 21, the rules are: foreign currency transaction is a transaction denominated in or requires settlement in a foreign currency. So as we said, buying and selling goods, borrowing or lending money, and of course then your trade payables, trade receivables could be in a foreign currency, or you could buy or dispose of assets in a foreign currency as well. So there are a multitude of different types of transactions, but the general standard rules will apply to each of them. So we need to know three key issues. How do you initially recognize the transaction? So when I make the sale, how do I recognize that sale? How do I account for the transaction at the end of the subsequent reporting period? So if I still owe money in a foreign currency, or I am owed money, for example, a trade receivable at the year end, do I retranslate it? Do I wait and retranslate it when I get paid? Or what are the rules? And of course then is, if there are any changes in FX rates, where do they get accounted for? Do they go through the P&L? Do they go straight to equity? Or do they go to the OCI? So you need certain rules for standardization across the board. So we'll look at each of those three. So the first thing is the initial recognition. So the initial recognition, the transaction should be applied at the spot rate. So you'll know from corporate finance and your FX risk management, the spot rate is the rate today. So what you're looking at, if you make a sale in dollars today, you make a purchase in sterling, you convert that into euro and you recognize it at the spot rate. So you either debit trade receivables, credit revenue, it could be debit bank if the money's coming in straight away, or it could be, for example, debit purchases, credit trade payables. But the key thing is you convert it at the spot rate today. So to show you a small example of that, you see here, Company X purchased a property on the 1st of December for 20,000, this is Deutschmark, so the old German currency of 3 months credit. So they're not going to pay until February 2015. Pay or start of March, into February. Property is depreciated over 50 years. Company X's year end is the 31st of December. So the initial purchase on the 1st of December, that will be at the spot rate. And the spot rate is here. €1 is worth 4 Deutschmark, or DM. So that means the 20,000 DM is the equivalent of, divided by 4, €5,000. And we're assuming we're always a euro-based company. So simply, the entry that you will make on the 1st of December is debit the asset, 5, credit other payables, or you can technically to other payables, trade payables is fine, 5 as well. So that's what we mean by record the initial purchase at the relevant spot rate. Now what I want you to put a note there to know is you don't actually owe €5,000. You still owe 20,000 DM. And the point is, as the time moves on between now and the 1st of March, the exchange rate can move, and it has moved as you've seen here. So that's where the rules come in around retranslation and around how to account for foreign exchange gains or losses. But the first key thing always is, across every transaction, the initial recognition is always at the spot rate. And the spot rate is what is the exchange rate at the date of the transaction. Subsequently then we need to figure out, well, what happens then post the initial recognition? And that will be dependent on the type of item you have. So this is an important distinction. The first thing is monetary items. So loans, trade receivables, trade payables, deposits. Anything that is essentially monetary in base. They should be retranslated because you are gaining or losing money every time the exchange rate goes up or down. It will have a monetary impact. So your trade receivable could be worth more euros or worth less euros as the exchange rate goes up or down. So those items are monetary items. All other items are what we call non-monetary. So property, plant and equipment, inventory, anything like that, they remain at the historical cost. So if we go back to the previous example there, that property, plant and equipment will never move from 5,000. And you will depreciate that 5,000 over the 50-year life. So even though the trade payable, as we'll see in a second, will go up or down as the exchange rates go up or down, the non-monetary items like inventory, like property, plant and equipment, they will never change. They're recorded at the initial rate and they're left there. So that's a key distinction you need to know when you're looking at IAS 21. And then one other little exception is any non-monetary item carried at fair value, they're translated at the rate, the date the fair value is determined. Now that's a bit tricky and it's a bit wordy. Essentially you're saying is, we know, and from your previous studies in IAS 40 investment property, that can be used in the fair value model. Well, technically, if you fair value investment property in dollars or in pound sterling, there's two things going on. There's the movement in the underlying fair value, and then there's the movement in whatever exchange rate happens as well. IAS 21 says you don't need to separate them out. You can just exchange or convert the updated fair value at that date. You don't need to split out FX differences and fair value movement separately. So it's only an exception, but just have it in the back of your mind. If there's ever investment property at fair value, there is an exception to the rule, as there always is in a lot of these standards. So monetary items are balances owed that will be settled in cash. Again, we've given the main examples there: trade payables, trade receivables, and loans. Non-monetary items, intangible assets, inventory, property, plant and equipment, share capital, etc. All of those are the same. So the key rule here, and this is important, monetary items will be retranslated. So at the end of every reporting period, any foreign exchange monetary items you retranslate, and you say that is now worth €5,000 or that is now worth €4,500. And you'll have a gain or loss at the end of each reporting period. You'll do nothing with non-monetary items. So they're a lot more straightforward. So since you're going to have two situations then, because the main complications arise with your monetary items. So we'll just explain it in narrative format first, and then we'll go through the same example again, just to consolidate our knowledge in this. So the first situation is where the monetary item is settled in the same period as the transaction arose. So that means in the same year, you buy the goods on credit and you pay them in dollars as well. So what's going to happen there is there's going to be an exchange difference from the transaction date to the settlement date. Because at the year end, the transaction is settled, so it doesn't appear on any balance sheet at the year end. The trade payable or the trade receivable, they've all been removed. So that's the more straightforward one. The second one you have to start thinking about a bit more, and this is what we're going to happen here. in terms of our purchase of the property. And this is where the monetary item is outstanding at the reporting period end. So what's happened there is we've bought it on the 1st of December. We're not going to pay it until the 1st of March next year. So that means at the 31st of December, that's the end of our reporting period. So we have to retranslate that trade payable, even though there's no transaction taking place. So you're going to have a foreign exchange gain. If we think about it here, I'll just draw it out. So I call it DOP, or we'll just call it purchase. Purchase here, the 1st to the 12th of, I think it's 14. The year end, the 31st to 12th, 14. And then I'll put here the payment, which is the 1st to the 3rd of 15. So it's important to understand your dates of what happens. So what we're trying to say here is, because this is a monetary item, the difference between here and here, we'll look at this as the yellow bar. There's now going to be here a gain or loss in translation. Put it there. You're going to have an FX gain, or you could have a loss on retranslation. So nothing to do with actually the settlement, because the settlement doesn't happen till the next year. But here you have to retranslate at the year end. And then between here, the end of the year, and the payment date, we're going to put in a different one. We'll put it, for example, in orange. And we'll merge it just to make it easier. You're going to have an FX gain or loss on settlement. Because you're going to settle and you're going to pay that money on the 1st of March, but it could be at a different exchange rate. And the point in separating them out is, this FX gain or loss goes in the 2014 accounts. I might have the year wrong, but the principle still says the same. This FX gain or loss goes in the 2015 accounts. So you have to split them out. And that's what this thing is telling you here. You have two separate FX gain or losses. And all the gains and losses go to the P&L. So they don't go to OCI. They don't go directly to the statement of change in equity. You just put them in the P&L. You can put them into admin expenses. You can keep them as a separate line item if you want. The key point is it goes in the normal profit or loss. So let's look at the same example again. So we know we initially recorded this property at €5,000 and we recorded the trade payable at €5,000. So I'll just put that in a little Excel. It shows trade payable equals 5,000. Right. We come to the year end now. That 20,000 Deutschmark is still 20,000. We don't owe euros, we owe the foreign currency. It's now converted to 4.2. So that is going to be trade payable equals 20,000 divided by 4.2. Which is 4761. We say 4762. So think about what's happened now. Because the exchange rate has moved, I effectively owe less euros. So that is an FX gain of 5,000 minus 4762, which is 238. And the reason it's a gain is the euro is strengthening. €1 is now worth more over the last month. That means the foreign currency is weakening, which means I need less euro to pay a fixed amount of foreign currency. And you will be covering that in corporate finance and FX risk management. This is how it translates to FR. So that's where you see it here, subsequent recognition, and you're reducing your trade payable, so you debit it, and you credit the P&L. We know credit to the P&L is a gain. So that's what we call the foreign exchange movement, or the gain here on retranslation. So there's just key small little things you have to think about, but these are all about practice. They're not the hardest area, but it's important to understand it. But then, so that's in the 2014 accounts. In 2015 then, the exchange rate has moved the other way. The euro is weakening. That means the DM currency, the Deutschmark, is strengthening. So we still owe 20,000 and we're going to pay it on the 1st of March. So on the 1st of March, we pay 20,000 of the foreign currency and the exchange rate is 3.7. So we're actually going to pay here 5,405. Why? Because the exchange rate has gone against us. The foreign currency has strengthened because the euro is weakening. And that means we're going to have to pay more euros to settle a fixed amount of foreign currency. This never changes. But because we're working in euro financial statements, we have to update each time. So this means, now remember, you're not comparing to the 5,000 because the opening balance in the current year was 4,762. That is an FX loss because the trade payables are going up and the loss is 644. You cannot net them together and show them as one entry because they're two different financial year ends. So be careful about that. So what you want to do there is you want to increase, now 643, 644 is rounding. You want to be careful what happens here. I'll show you separately to make sense of it. You're going to credit bank 5405. That's obvious enough because that's how much we actually paid based on the exchange rate. You're going to debit trade payables 4762. There's no point debiting trade payables anymore because that's all that was in there. So that means you're balancing debit P&L 644. And that is, no, that's just rounding. It's technically 643, say, because the Excel is rounding. P&L. Now that's an FX loss. Debit to the P&L is an expense. So just be careful that you're not just moving the trade payables because at the 1st of March, you're actually settling it. So you remove the trade payable, you bring in your bank entry, and the difference must be the FX gain or loss. In this case, you lost money because the exchange rate moved against you. So just be careful whether it's a foreign exchange payable or whether it's a foreign exchange receivable. Because of course the entries will be the opposite and thinking about gains or losses will be the opposite as well. So that's where that's coming from. And the key point about the property is if you're asked to treat it, property is a non-monetary item. So it's not retranslated. So that just means your depreciation is based on the 5,000 and you charge 100 depreciation each year. Same would be if you purchased inventory. The inventory is not restated. It's just left at its original entry amount. So that's the key difference between monetary and non-monetary items. So let's have a look at two examples then, one of each different type of situation, just so we see what's getting on and how we're getting on with it. So monetary items settle in the same period as the transaction arose. This is a more straightforward one because we'll never have a gain or loss on retranslation. Because if the transaction is already settled in the same period, it's not there at the year end to be retranslated. So you're only ever going to have a gain or loss on settlement. So for example here, Blue has a year end 31st December and buys goods from a foreign company for 180,000 ricos on the 31st July and they settle it on the 31st of October. So what you're thinking about there is that means there's nothing outstanding at the year end. It's already been settled. So the initial recognition here is going to be 180,000 divided by 1.5. So you're going to recognize purchases 120,000 euros. So it's going to be debit purchases and it's going to be credit trade payables. Because of course you bought it on credit because you didn't settle it till another couple of months. So that's your initial recognition is based on 120,000. Now at the end of October and Halloween, they settled it when the exchange rate was 1.6. So let's just work through that. So initial will be 180,000 divided by 1.5. Settlement will be 180,000 divided by 1.6. So what has happened here is the exchange rate, the RICO, has weakened. Now just because it's higher, that means the euro has strengthened. 1 euro is worth more. So that means the RICO is worth less. And that's actually good for you. So when you're importing goods, when you have a foreign exchange payable, the weaker the foreign currency, the better. Because that means it takes less euros to pay for a fixed amount of foreign currency. You have to pay 180,000 RICO. So this is an FX gain. Because you can settle it for less than you initially recorded it for. 7,500. Now, there's two ways to go about this. You can either do one net journal like we will, or you can do them separate. And either is fine. So you're going to credit bank 112,500, which is the actual settlement amount on the 31st of October. You're going to clear out trade payables, the 120, like we just done in the previous example, because that's the only 120 that was there, the initial recording. and then you're going to credit FX gain in the SOPL 7.5. And there are your entries. And nothing more than that in terms of the adjustments. So you record it initially at the spot rate, record the gain or loss in settlement, and be able to provide the journals. Now note, this can come up in any question because it's to do with an individual company. It doesn't have to be a foreign sub to have this here. So you'll see this pop up in a lot of exam questions, even in any type of consolidation question. So if we go back here and have a look at the answer, they're just done separately. You can net them together. They debit trade payables, credit cash 112. They debit trade payables 7.5. And they credit the P&L 7.5. So we've just done those trade payables we've put as a single entry of 120 as opposed to splitting it. But either one is fine. And if you want to put a little note, there is no retranslation at the year end because there's nothing to retranslate. The monetary item is gone. And inventory is measured at the 120. So if those goods are not sold at the year end, they are not retranslated because inventory is a non-monetary amount. So what you're going to do there then is you're just going to leave the inventory at 120,000, which is the initial recorded cost. So that was the more straightforward one, where you have the transaction and the settlement in the same period. So what we're going to look at now is the more complicated one is, well, the similar one that we looked at originally. What happens if the monetary item is settled in a subsequent period? Well, you're going to have 3 steps then, really. First thing, record the transaction initially at spot. You then, step 2 and 3 is determine the retranslation gain or loss at the year end, like we did with the properties transaction in Deutschmark at the early example. So that's the second step. And then the third step is, when you settle it next year, record the FX gain or loss in settlement. Again, like we've done with the Deutschmark property example up front. So you really just have an extra step here, these 2 and 3. Because the fact that the transaction straddles 2 accounting periods, IAS 21 says any monetary items must be retranslated at the closing rate at the end of each reporting period. So it is quite repetitive, but it's important to practice these questions because you can get different variations. It could be a loan, it could be a sale and therefore a trade receivable, or it could be a purchase and therefore a trade payable. So take this little example. So RTP purchased machinery on the 1st of November for $100,000. Dollars is the foreign currency, and it was paid on the 15th of January. And the year end is 31st of December 2014. And you have your relevant exchange rates. So if we come back here, and we'll draw it out just for clarity more than anything. And we'll bring it down here, just to make sure we're bringing everyone at the same pace. So your purchase, 1st of November, 1st to 11th, 14. Year end, 31st, and payment, 15th of January, 15. So we're going to have an FX gain or loss in retranslation here, and an FX gain or loss in settlement here. So the initial recording is going to be done at an exchange rate of 1.457. So $100,000 divided by 1.457. So that's going to be about 68,600 euros. That's the exchange rate. So $100,000 divided by the spot rate at that date, and that will be debit PPE, or plant and machinery, P&M, and you'll credit trade payables, or in this case you could call it other payables if you wanted. So that will be the entry on the 1st of November. Debit plant and machinery, credit trade payables, 68634, 68634. That's your first entry done. And we'll just put there the 1st, 14. At the 31st, 12th, 14 then, we need to figure out, well, what will the retranslated trade payable be equal to? Well, you're saying you still owe that $100,000 at the end of the year because you're not paying it till next year. So you need to retranslate that $100,000, that doesn't change, at 1.501. And that means the $100,000 are actually now going to be 66,600. So think about it now. We're all dealing with foreign trade payables here. You could have trade receivables as well. This is a reduction. So this is an FX gain. Because you thought you were going to have to pay 68.6, you now only have to pay 66.6. So that's a gain of 2012. So always think about it. Sometimes higher is better if it's a trade receivable. Lower is better here because it's trade payables. So that will be reduce my trade payables by 2012 from 68 down to 66 and credit the SOPL FX gain 2012. And that is what we call the yellow item here. That's your FX gain or loss on retranslation. 2012. And that will be done at the year end. So your trade payable now going into 2015 will be 66,622. The 68 is now gone. It's been retranslated down at the year end. So you're going to settle $100,000 for how much you're going to pay on the 15th of January. You're going to divide by 1.509. So it is quite repetitive. But just make sure you understand the mechanics because it can be quite complicated in an exam question. You could have a part settlement. Some of it settled before the year end. Some of it settled after the year end. So that's about 66.2. 66.2. So what we're saying here now is what's going to be the entry. So think about it now. Can you do the debits and credits? And pause this recording, try the debits and credits to make sure you understand it. So I'm going to credit bank. I'm paying 66,269. My trade payable that I had was 66,622. So that means I have a balancing figure on the credit side. Credit the SOPL FX gain of the difference. Because essentially I settled it for 353 lower than I had it in the books. Because the exchange rate moved marginally in favor. The euro is worth more dollars, that means the dollar is weakening. And when you have foreign exchange payables, the weaker the foreign currency, the better it is for you. When you have a foreign exchange receivable, the stronger the currency, the better it is for you. So it works different ways. That's why it's important to understand, do you have a purchase or do you have a sale when you're looking at the question? And they can vary from question to question. So you can see here in your solution there the gains or losses. And they're the debits and credits that we've gone through already with you. So again, that's just it split out, but you can equally put it as a net journal like that. You get full marks as well. Right? So there are a couple of small rules dealing with foreign currency transactions, but the key point is about practice. There's a full question pack there to go through, and you'll see this adjustment peppered through a lot of the past exam questions as well, because it's not related to any particular consolidation. It can be put in any question. So it's an important one to go back over. Right. So your monetary items, then exchange differences. So the key point here is it should be recognized in the P&L. Where a gain or loss on a non-monetary item is recognized directly in equity, then the exchange rate should go there as well. Now that's related to IAS 16. It's a little thing to watch for is if you have property, plant and equipment using the revaluation model where you're remeasuring or revaluing property, plant, equipment on a regular basis, you don't need to split out movements in exchange rates and movement in the value of the asset. You can put everything in as a single line into OCI. Same what I mentioned about IAS 40. Technically, when you're fair valuing investment property in a different currency, there's two things going on. There's the movement in the currency, and there's also the movement in the fair value of the investment property. They don't expect you to split it out. You just put it all in the P&L as a single line item. So again, they're just smaller things, but just watch for them. And you'll see one of those in the question pack when you go through it. So it's a small thing to have in the back of your mind, but it's not a huge issue. So your summary then is IAS 21 is a brand new standard for you. It covers two areas where a company engages in foreign transactions. So transactions denominated in a foreign currency, and that's not related to consolidation. And that's what we focused on there today. And there's simple rules around how to initially record it, the difference between monetary and non-monetary items, and how you deal with exchange differences then. Exchange differences at the year end, which we call retranslation differences, or exchange differences on settlement. The one we're going to look at, the second part of that, which is a bit more complex in IAS 21, is where you have an interest in a foreign operation. In particular, we're looking at foreign subsidiaries and how you retranslate them to do a euro set of group accounts. And we'll do a separate recording on that and practice questions as well. So for now, I want you to go back and look at question pack 7. There's a number of different questions focused on individual transactions. Some of them are quite tricky, so make sure you practice trade receivables and trade payables and watch for those questions that have come up in past exams where some of it has been settled before the year end and some of it is settled afterwards. So they're a bit of a step up than the examples we've looked at now. So that was the first part of IAS 21, looking at foreign currency transactions.